welcome everybody to our second session of the 2024 Not-for-Profit Speaker Series. We're really glad to have everybody joining us today or rejoining us as we continue to explore some of the hot topics in the not-for-profit sector and what you can do as an organization to help be better prepared for the ever-changing environment for not-for-profits. We've got a great session in front of us. Today, we're going to be covering a very important accounting update that's going to be effective for this fiscal year. So very timely topic to cover, which is the current expected credit loss standard impacting not-for-profit organizations. So hopefully after this session, you've learned enough to be on your toes, to have an educated conversation with your audit firm and kind of know everything that you need to know to be involved with this new standard. So with that, I will hand it over to Amelia and to Roselle, who are going to be presenting this topic. Great to have both of them. Roselle and Amelia, I hand it to you, but before that, wouldn't be the start of a session without a quick dad joke. So two windmills are sitting in a field next to each other, and one says to the other, "Do you have a favorite song?" And the windmill says, "Well, I've always been a heavy metal fan." A heavy metal fan, right? All right, that's all I got for you, but take it away, Amelia and Roselle. Appreciate your time.
Thanks, Matthew, and welcome everybody. We've got some slides we'll start sharing with you on the current expected credit loss standard. So very exciting topic, maybe just for accountants. Today, we've got myself, I am Amelia, and Roselle, and we're going to be going through the standard, kind of a background on it, and talk through the changes that are coming. All right, so if we go to the learning objectives, these are just after this class, what we hope you'll be able to understand and apply. And as we go, feel free to put any questions you have in that either chat or the question and answer pod, and we will be happy to answer them as we go. So to kick things off, we'll start with a polling question. So really, what brings you here today? It may be that you know about the standard and you want more information. It's another new standard again. So now that you have to implement it, you're here. You had no clue there was a new ASU till you saw the speaker series and signed up so you could understand what was changing. Or, like I'm sure many of you are here for, fun, obviously. So we'll give everybody a minute to answer that poll. Please make sure you respond to it, as that's what's going to drive your CPE credit. And I'm not able to see the response rate yet, but Maddie or Eunice, perfect. There we go. So here's the results. So a pretty mixed group, which is great. 24% for fun. That's exciting. Very, very high percentage there. All right. So why are we here? There's a new ASU, and I know there's a lot of acronyms on this slide. We just want to make sure that you had it in all of its forms so that if you heard the reference, you would understand it. So we've got a new accounting standard update, or ASU 2016-13. It's codified as ASC 326 or topic 326, and it's referred to as the current expected credit loss standard. And that is because it set up the current expected credit loss, or CECL model, as part of that update. And what that's going to be looking at is an immediate recognition of estimated expected credit losses over the life of a financial instrument. And I know this is a lot of words here for everybody, but we're going to go through all kinds of definitions and terms with you guys, so don't worry about all of that. And then obviously with this last piece here, management must determine what that estimate would be. And that's going to consider historical information, current information, and then also future economic conditions and events. And that's really what makes it the CECL model. So if we look at the timeline, this ASU did come out in 2016. So it has been around for a few years. A lot of times when we have standard updates like this, they tend to kind of get pushed back a little bit. So we are now finally at that effective date. So they became effective beginning December for fiscal year ends that begin after December 15th, 2022. So if you were a calendar year entity, you probably have already looked at this standard as that was applicable for fiscal year end December 31st, 2023. If you are not a calendar year, you likely are looking at an upcoming implementation. And it does allow early adoption, so you are able to adopt that early. But otherwise, those that have fiscal year ends in this year that are coming up, you are looking at implementation of the standard. So I think a good starting point when we're looking at this is really getting a good understanding of what was our previous state, or what did US GAAP have before. So previous GAAP required what was referred to as an incurred loss methodology, which really just means that you were delaying recognition of an allowance or potential loss until it was probable that a loss has been incurred. And so it had that threshold that you would have to meet of being probable. Back in 2008, the FASB and the International Standards Board set up kind of a group to look at, based on the global financial crisis that had happened, where are there room for improvements in the standards when it comes to looking at credit losses? And so what they recommended was that the FASB look at US GAAP because we were waiting for that probable threshold to be met. And they felt like that was, kind of overstating assets if you didn't have an allowance kind of at inception. And so that led us to where we are today, where we're looking at a much broader picture when we're looking at estimates of credit allowances. So if we look at an overview of ASC 326, the topic is intended to improve financial reporting by requiring earlier recognition of those credit losses. So under the previous GAAP with that incurred loss, you'd be waiting for that probable threshold to be met. Now, under the new standard, they're really looking at that estimate at the point of inception of the asset. And we're not waiting for events to become probable to record an estimated loss. We're really estimating what we expect over the lifetime of that asset to be the potential losses that we would record. So based on this, most entities are going to see an increase in the amount of the allowance that they have recorded. So previously, you may wait till something was past due, and then you may not fully write something off until maybe somebody filed for bankruptcy. Now, looking under the new standard, we don't scope out those current balances because we're going to look at things right from that point of when it was recognized. So you're not going to have a reduction in your scope of the allowance that you'll apply. And then on top of it, we don't have that probable threshold anymore to meet to record some kind of allowance. So now we're estimating those allowances over the lifetime of the asset at that point of recognition. So because of those two pieces, you're likely going to see that increase in your allowance. So I think it's important to pause and understand a couple of the terms that get used during this process of evaluation to really understand what it's referring to. So a financial asset and the amortized cost basis, both the definitions are here on the screen, and they were clarified as part of the standard update. But a financial asset, you can see, is really looking at the cash, evidence of ownership in an entity, or a contract that conveys from one entity to the other the right to receive cash or exchange other financial instruments. So really you want to think about things like trade receivable, account receivable, loan receivable, securities, investments, things like that. Those are all things that would be considered financial assets. For amortized cost basis, this is looking at how those things are recorded. So that's going to basically take that original amount that was used to create the asset, but then it's adjusted for the items that are listed on the screen. So you may have adjustments for things like premiums or discounts, deferred fees, write-offs, exchanges, things like that. So when we talk about these, the financial assets is going to be those actual assets we're looking at and evaluating. The amortized cost basis is going to be looking at how they're recorded, and that's going to be net of any of those types of items that are shown on the screen. So understanding the old method to the new method is a good starting point to be able to apply the CECL model for the current year. So that previous incurred loss model, that's where we talked about losses are recorded when they are probable of being incurred. It also had no indication of loss, requiring no reserve. And we'll talk about what that means under the new standard. We had it solely based on historical experience. It was a very backward-looking approach. And like I mentioned, it's typically applied to those past due amounts. So it really wasn't taking the full scope of receivables. It may just be looking at those that are considered, say, over 90 days in past due. Under the new standard with the expected credit loss model, there is no threshold that you have to overcome for recognition. So before we would follow probable, we don't have to follow that now under the new standard. The allowance is also required, even if it's considered to be remote, that there would be any kind of losses. So previously, we would only look at those past due amounts, for example, or you may say no allowance is needed, that customer hasn't had any issues paying, we have a long-standing relationship. Now the standard says that the allowance needed may be small, but an allowance is required under the new standard. And then we also want to look at not just that backward approach of looking at historical considerations, but we also want to look at the current market and then where we see things going. So those forecasts as well. The caveat to it is we obviously want to use reasonable and supportable forecasts. That's kind of talked about in the standard update. And so when we're looking at that future data, we do want to take that into consideration. And then, as I mentioned, we're applying it to all of the balance, not just those that are considered past due. So there's no more scoping of that balance is only 30 days old. We expect to fully collect it. We have to estimate what the potential lifetime losses are for that asset right out the gate. So that just basically means that there's no balances that don't have some kind of risk of non-payment associated with them. So even if historical experience tells you haven't incurred losses on them, right now under the new one, it's not just what have you incurred before, but also what could you potentially be facing because of the market or future market changes. As we're looking at the transition, you are going to use what's called a modified retrospective approach. And what that basically means is that instead of going back into those prior periods and restating what your allowance would have been at that time, you're going to analyze the cumulative effect of applying the standard at your opening net asset balance. And that would be for, the year that you're applying it. So for this year, it'd be for this opening year's balance. The adjustment that you would be analyzing is going to be the difference between what your allowance was under the incurred loss method or what GAAP was previously versus what your allowance would be under the new credit loss standard. And then that difference is what you would consider as your cumulative effect. And that's what's going to be related to your opening net asset balance. So not expecting that entities need to go back into their prior year balances. So if you're a 6/30 year end, we're not expecting that you go back to 6/30/23 and restate anything. It should be applied as of 7/1/23 as your kind of modified retrospective approach. And then when you're doing your disclosures and your financial statements, you want to make sure in the footnote you mention that you are using that modified retrospective approach so that it's clear you're not going back into those prior period and changing anything. So I'll pass it over to Roselle and we'll talk about the actual adoption and calculation.
Thanks, Amelia. Good afternoon, everyone. So now we're going to get into a little bit of the nitty-gritty about how to come up with that estimate. So as Amelia mentioned, you're going to be looking at historical information, adding a current considerations to that, and also some future components. And we've broken that down into 5 easy steps. So I'm going to walk you through those steps next. So first, the first step is determine what instruments are within the scope. So here we have a list of the various items that are within the scope. I know there's lots of words on here. So for a not-for-profit, primarily what you're going to be looking at would be your financial assets measured at amortized cost, which would be your trade receivables and your loans and notes receivable. You're also going to be potentially looking at if you are a lessor, and this doesn't apply if you're the leasee, but if you're the lessor and you have some sales type leases or direct financing leases, those are also within the scope of this standard. And then we also have listed here that some available for sale securities could potentially be in as well. This would only be if you're a not-for-profit that is considering or grouping some of your investments as available for sale. Most not-for-profits are actually recording those at fair value and adjusting that value through your statement of activities. And so in those instances, your investments would not be in scope. But if you do have some that are following available for sale accounting, then those would also be in scope. So step 1 is to look at your statement of financial position and determine which of your financial assets are within scope. So let's talk about what's not in scope. And I've seen a couple of questions come in the chat. So I've saved the responses to this question for this particular item. So as we mentioned previously, trade receivables are in scope. So any of your revenue items that would be considered 606 revenue would fall under this CECL accounting model. Or grants that are following the contribution accounting, then those would not be in scope. So one of the questions was, whether you would have federal or state government type receivables would be within scope. Most of the time you're accounting for those as you would contributions. But if you did have any instances where those might be falling under your 606 revenue standard, then they would be in scope. So just a couple of items that we think will probably most likely apply to most of our not-for-profit clients. Trade receivables, so anything, tuition and fees, anything from your program revenues that are generating receivables would be within scope. Again, if you have any loans receivable, those will be in scope. And then if you have direct financing leases or sales type leases, those would also be in scope of this standard. And now it's time for another polling question. So what financial instruments do you have that are subject to the new credit loss standard? Trade receivables, loan receivables, financial guarantees, or net investment sales and direct financing leases. And I'm not sure if you can select more than one. So yeah, it's a single choice. So pick which one you have the most of if you have multiple options. So we get there. Oh, here we go. So as we expected, it looks like most people, your trade receivables are going to be within scope. About 23% have loans, very small amount have financial guarantees, and then we do have some entities that may have sales type and direct financing leases as well. So.
And Roselle, we do have a question that
Okay.
came in, that's asking about if you're owning and managing affordable housing, would those tenant rent receivables be scoped into the standard, or would they, be accounted for otherwise?
Oh, Amelia, I feel bad. I don't know the answer to this. I think that you would, because I know that scoped out is the operating asset
That's
related
right.
to leases is scoped out.
But I believe
But
the
I would think-
receivable balance is, because that is still 606 revenue, it's still exchange revenue, that you're likely looking at those being still scoped into the standard. So I think it depends which asset you're looking at.
Correct, yeah. All right, so step 2. So now that we've identified what our different groups of instruments are going to be, we're going to pool them into risk pools. So when you're going through and determining, how to pool those assets, what you're trying to think about is you need to group them and together with other entities that have similar risk categories. So some of the examples of how you could do this would be with aging, credit risk. You could look at geographic risk if that you feel like would play into some of that potential credit loss. Or you could even do it by, some other categories as well. There's really no prescribed definitive way of doing this, but you really want to be thinking about grouping them into similar categories that would identify that risk associated with them. One thing I was thinking about is with higher education institutions, a lot of times you kind of have a homogeneous population that you're looking at. And you do have past dues, but it may be that more of the risk is in the students that have graduated versus the students that are current. So I think that you really want to be thinking about, what are the parameters that would change the risk for this particular financial asset and grouping them in a similar way so that you're coming up with a meaningful estimate of that credit loss. So then as far as step 3, we're going to select the method for determining losses. So a lot of what's going to come down to determining your method is going to be how available is the data for those particular options. So the 2 most common ways of looking at or determining your loss would be using a loss rate or looking at it by aging. And it's been interesting seeing how some of our December 31st clients have gone through and adopted this. I was had a meeting this morning with some of my other partners and was asking them, what they've been seeing with their clients that have been adopting this. And I think consistently across the bat, most of us have been seeing our clients using the loss rate as opposed to the aging rate. Because most entities are able to go through and calculate what is that loss rate, write-offs divided by sales to determine what has that been historically. Doing that estimate based on aging is a little more difficult, and a lot of it's going to depend on the sophistication of your system and what you can get out of it. So there's some different options of doing that, but next step is determine which of these methods you're going to use. So we have another polling question. All right, so how many steps are in the CECL calculation process? 4, 5, 8, or 10? So are we ready for results?
We have about 95% participating. So
Okay.
if you wanted to go ahead and submit your response, and then we will close it out in the next 10 seconds. Okay, perfect.
All right. Oh, y'all, it's so good paying attention. 56% are correct. There are 5 steps as opposed to 4 steps. I know some of us may be wishing there were 4 instead of 5, but there are 5. And only 2% picked 10. Thank goodness there are not 10 steps. So moving through the rest.
We actually have got another question as
Okay.
well, Roselle, if we want to pause and take a
Sure.
look at that. So the question that came in was for trade receivables. We listed the example, obviously, of tuition and fees. If they're a membership association and we have receivables for member dues, would those fall under that as well?
Yes, I think most likely they would. Most entities are accounting for those under 606 as opposed to following contribution and grant accounting. So I do think that membership and dues receivables would fall under this accounting standard.
And that's a great thing to just keep in mind when you're looking at your different types of receivables, is really to think to how you have the revenue recorded that's associated with it. So if it's going to be your support or that contribution, that's where it'll get scoped out as part of pledges and support. But if it's going to be related to anything that is exchange transactions or 606, that's where it's going to be within scope of this standard. And if you have financial statements with the footnotes and you're uncertain of how you have that classified, that is something that's typically disclosed as part of your accounting policies. So a quick and easy way to kind of double check yourself for how that's being captured is to take a look at your accounting policies and see how you have it discussed. Contribution accounting will usually talk about the fact that it is contributions and not an exchange transaction, versus the exchange accounting or 606 will talk about what you do in order to earn the revenue and record it. And so that'll kind of be a good way to figure out which types of receivables are going to fall under the standard.
Yeah, thanks, Amelia. That's a great tip. So step 4 is going to be to actually compute that historical loss experience. So as you're going through and looking at this, what you're going to be looking at is what are those actual write-offs as a percentage of your revenue. You can use kind of as many years as you think are meaningful for that calculation. So there's no set, it needs to be 1 year or it needs to be 3 years. You can really look through and say, okay, when I'm looking at my historical losses and thinking about, you know, what is representative, kind of where we are, what do I think is most meaningful from that calculation? You know, I've had some clients when they were doing that who've adopted it as of December 31st, who looked and said, you know, we feel like we're going to exclude kind of the COVID years because the write-offs related to those aren't really representative of our losses overall. And so we're going to use, you know, 2022, we're going to skip, you know, 2021 and 2020, and then we're going to pick 2019 and 2018. So I think that you have some leeway. You just want to make sure that the method that you're looking at and the years that you're using makes sense.
One thing I'll add as well, just that I've seen an application from the 1231s, is that to make sure you're not just using current year losses as well. There's been a lot of entities that when they have first sent it over, they've maybe done the year that they are currently evaluating plus 1 year prior. You want to get a little bit more data than just that, because the current year is really looking at the current period rather than looking at historical losses. So just keep in mind that what's in your current fiscal year, you want to add to that. You don't want just 1 year. You should add at least another year or two to that data, and not just solely use the current year as a marker for historical consideration.
And then step 5, after we've determined the historical loss, we're going to add some current conditions and some supportable forecasts to that. So as you're thinking about the current conditions, you want to think about, you know, is there something new going on this year with our entity that we should be incorporating? So do we have a new revenue stream that wasn't included in the historical data that we want to be thinking about and capturing and adjusting for? Is there a new program that we've done that we need to be thinking about? Or have we changed our customer base this year compared to prior year that we need to be thinking about and adjusting for? So you want to be looking at current conditions and also adjusting for that. And then the future considerations is also, you need to be adding a little bit on top of that. And I think that the addition of the future considerations is really where you get into a situation where it's really difficult now to say we have no allowance, that, you know, we think historically maybe we didn't have any write-offs, but saying going forward, I don't think we're going to have any. Adding this future considerations makes it a more difficult case to make. And there are lots of benchmarks that you can use for this. You just want to look and see, okay, what is my, what asset am I using, what population, and then tie your risk that you're addressing to that future consideration. So you could use, you know, the Federal Reserve yield curves as an estimate. You could use future GDP projections as an estimate. A lot of it just depends on what is that particular risk that you're looking at and which future consideration benchmarks fits that the best. So here's an example of kind of putting all of that together. So first of all, in this example, the entity calculated their historical loss rate, and they looked at their AR to tuition and fees and said that, all right, my historical loss rate has been 4%. So that's kind of my base where I'm starting off from. And then they said, all right, what's new, what's different this year, and identify that they had a new nursing school open. And so that may be something that hasn't been reflected clearly in the past. So we need to add an additional adjustment for that. So after considerations, they set that risk at 1%. And then they said, all right, now we need to add that future forecast consideration. And so looking at that, they determined that they were going to add an additional 0.5% on top of that to calculate a full loss rate of 5.5%. So that's a real high level way of kind of looking at that and taking all those aspects and putting them together.
And we did have a question come in about a comparison of the current model and whether it's yielding a higher rate compared to the prior years. And that is something that is likely, as you can see from, if we flip back the slide, Roselle, from the example, you know, if you only use that incurred loss method before, you'd be at that 4% level. Now, under the new model, you're going to be moving more towards that 5.5%, where you've adjusted for current conditions and then also that future consideration. When you're applying it in the current year, you're going to use that modified retrospective approach. And so that's where you're going to evaluate the difference of that 4% versus the new 5.5% that you're using. And that difference is going to be considered against your opening net asset. So you're not going to go back into those prior periods because it's using that modified retrospective. It's not going back and restating them. Instead, you're going to evaluate that 1.5% difference between what the old model was under that incurred loss model versus the new model with CECL at the 5.5%. That's what you're going to evaluate against your opening net assets. And if you have an adjustment that needs to be done, you would apply it to that opening net asset balance. And so you don't need to go back in your prior periods and make any changes. You're only going to flow that through as a current year effect. And when you're doing that, you can obviously use, you know, if we're looking at a 6/30 year end, you can use your 6/30/23 balances to estimate what your 7/1/23 balances or your opening balances for the fiscal year would be. And then you would just apply your new allowance rate against that balance to tell you what was the difference in the allowance on those outstanding amounts at that point. And then that would be what your opening adjustment would be. And if you get to the end of the year, then you would have any adjustment needed to get to what your ending balance needs to be based on those assets that you have at year end.
And we got another question, Amelia, which actually is a good one because it addresses one item I meant to mention anyway.
Yep.
So the question is, can current conditions adjust the historical loss rate negative to decrease the allowance? You know, I don't think that there's anything necessarily that says that you couldn't do this, but you would need to have some really supportable evidence for the reason that you're adjusting it down. I would almost say that maybe there's something in that historical loss rate that you may want to say is an anomaly, and we don't feel like is really representative of our historical losses overall, so we're going to exclude it. I think that the other thing when you're looking at your risk pools, you can also say, all right, we have this one particular receivable that we're just going to assess and consider its allowance separately. We're not going to put it in with our other risk pools because maybe it's a one-off receivable or item that you've done that really doesn't fit in with any of your other receivables. Or maybe it's something that you've already identified really does have a specific loss that's not really representative of the rest of the population. So you can go in and use those qualitative aspects and really bifurcate your risk pools into more specific pools if you've determined that's necessary. I don't know, Millie, if there's anything you want to add to that question as well.
No, I think that's perfect. I agree. I think remembering that those risk pools are really something that you're going to tailor based on what you have. And so it's not that you have to stay within one of those prescribed examples. You can create additional pools based on what you need. All right. I think we got one more question, Roselle. I don't know if you got a chance to.
Yeah, no, I was just reading it. Why don't we move on, Amelia? I can read it and then
That sounds great. Yep. And I think we've got another one as well in the
Okay.
chat, so we can come to those in just a minute. All right, so one and done, right? Once we calculate it once, we're good. Of course not. It's accounting. We got to do it annually. So looking at subsequent measurement, each reporting period, you're going to have to update the estimate of what you have as those lifetime expected credit losses. And then any adjustment to the allowance should be done based on the change in your estimate. So similar to what you'll be doing this year as part of your implementation, in future years, you'll relook at those historical loss rates. You'll make additional considerations for what your current market looks like, and then also make any adjustments for any future changes. You'll come up with your new allowance rate, and then that adjustment in between, maybe you had 5.5%, like in our example, but by the end of the next year, you're at 6%. That increase in rate, you'll have that adjustment to your allowance, and then the resulting credit or debit, depending on how you adjust your allowance, is going to go through that credit loss expense, which really mirrors the current approach as well with the allowance for doubtful accounts. It's just now the language is shifting to credit loss. So same kind of thought process as what you've been doing before. You just have to look at this analysis, the pooling and the historical considerations, and then your current and future considerations annually. You can certainly do it more frequently than that if your organization prefers to, but it is something that it's really just going to be getting that right for each of your year-end periods. All right, so what about write-offs and recoveries? So write-offs should happen in the period in which you've made the determination that the financial asset or portion of that asset is uncollectible. Now, when you look at the standard, uncollectible is not a technically defined term, meaning that it's going to involve judgment from management to decide when something would be considered uncollectible. Generally, that's where you're going to want to have exhausted all your options for collections. And then at that point, you can determine it's uncollectible and write it off. By that point, you likely have already set up a substantial allowance. If you're pushing something through a collection process, then you likely have already estimated a high allowance on it based on the fact that you're going through this process. So in that case, you're going to remove the allowance that you would have recorded. You're going to remove your asset balance. And then if you did have any remaining difference between the allowance and the asset balance, that would hit that credit loss expense, similar to when you're setting up the allowance. If you were so lucky to then have some recoveries on amounts that you had previously written off as uncollectible, then it would follow very similarly to what we have now. You're going to debit your cash and you will have a credit just to your income to pick that back up. And then another consideration or question that we get a lot is, can the allowance be zero under CECL? So can you have no allowance that you deem necessary? The standard's pretty explicit in this, that their example of when expected non-payment or loss is zero, they have the US Treasury as an example. And while they say that it's not intended to only be the US Treasury, the criteria that they list in order for you to be able to say that you could have that risk as zero, one of them is the ability to print currency. So even though they're not explicit in that, the big four national firms, we all feel like it's really going to be challenging for you to say that you have an allowance of zero, even if you have a history of not incurring losses. Maybe it's a highly rated customer, or you just have had great collections in the past and it's always been timely. While that's excellent, and you may have a low allowance on it, you may not have a high percentage, you can't say that there is zero risk related to that. So in those cases, you'd have to look at the facts and circumstances. Obviously, you may determine that allowance would be immaterial, and you may not have something recorded if that's the case. That would be something you would have to evaluate on a case-by-case basis. It's certainly not something you can just blanket apply across the board. But you can see some examples of some facts and circumstances here of where it could be that you have a very low loss rate. But it's important to understand that under the standard, it's really the government only that you can say is a zero loss rate. Everyone else, there is some level of risk associated with the balance. So just important to keep that in mind.
Yeah, and I think, Amelia, this is where that, future estimate comes in as well, which is once you add that, it makes it really hard to make the case to be zero. I also think, even if you feel like your case is zero, remember, you're going to have to document that. You're going to have to document this, whether or not it's zero or it's $25,000 or it's $1 million. So just keep that in mind, that your auditors are going to be looking for a well-documented analysis. And we did have a couple of other questions, which I thought we could answer real quick.
Yeah.
Again, going back, I think a lot of people are kind of thinking about how would I put this model together, and what would my credit, what have my previous history of credit losses been? I do think it's possible you could have some years that may be more volatile than others. And that's another instance of where you may say, okay, we had one large write-off for this one particular year. So maybe you adjust your losses for that particular year to exclude that write-off. I think that's another reason, to your point, Amelia, why you would want to have a couple of years in that estimate, is because that smooths a little bit of some of those ups and downs as far as what that historical credit loss was. And then just to clarify again, any of your investments, debt, equity, alternative investments, anything that you're carrying at fair value that's being recorded with the change going through your statement of activities is scoped out of this. So you do not need to make any sort of CECL adjustment for those investments.
Yeah, I think it was really just those held to maturity, right, that were going to be the ones that are under consideration for the standard.
Yeah, and I think most not-for-profits are recording all of their investments at fair value.
Yep, absolutely. And that's where it's important to remember those definitions at the beginning of the slides as well, that we're looking at things at that amortized cost basis, especially. So those are the ones that are going to have those allowances associated with it. All right, so looking at an example disclosure, this one is an example university disclosure. And so really the things to keep in mind is that you do have to disclose your policy and methodology for developing your allowance for credit losses. So you can see in the paragraph below, it will look very similar to what you've had in the past. There's going to be a few changes. You're going to see that change from allowance for doubtful accounts to move to allowance for credit losses. What's important about that language change is really about the fact that this is not that incurred loss methodology, right? So it's not an allowance for those doubtful accounts that you have anymore because you're recording it on all balances. You're not scoping things out. So that's part of why the standard has shifted some of that language. Now you're recording it at the point of inception, so no scoping of current versus old balances. And so they've shifted some of that language that you'll see in the paragraph. Additionally, you can see about midway through the paragraph, it's going to talk about the fact that they're separating their accounts receivable into risk pools based on their aging. And then they'll be determining the allowance using their loss rate that they develop for each risk pool. And so that's where they're going to factor in those historical considerations, the current and then future economic conditions. And then you can see an indication here of the loss rate that they're recording. So not massive changes in the disclosure itself, but it is adding a bit of wording changes and then adding in about that methodology as well. The other change that you're going to see is this roll forward of your credit losses. And so in the footnote now, you can see that it's going to show what those changes in the allowance for credit losses would be. And so thing to keep in mind here is the roll forward's not required for the prior comparative period of adoption, right? Because it's a modified retrospective approach. So we're not going back to that prior period and restating. We're looking at everything as of the opening period. So that's why you see in that first row of the table that it's the balance at the beginning of the period. You can see the impact of the adoption. So that's where you would have gone from that 4% example of incurred loss to 5.5% under CECL. And then you can see the new provisions and then any write-offs net of any recoveries to get to that ending balance that's being presented at the end of the period. All right, so looking at some key takeaways. The first is that this topic and standard is really not something that just affects banks. When it first was coming out, that was kind of a misunderstanding that a lot of people had. And then the second here, trade and notes receivables are going to be really what your most impacted pieces are. As Roselle mentioned, those investments that you have that are recorded at fair value, they're scoped out. So you don't need to worry about those items being under the standard. It's really going to be predominantly trade, notes receivable, loans receivable, things like that. Then the third takeaway is that you still have that historical loss experience that you need to have computed. So this is not taking away the past consideration. It's just adding to it. So you do still need to evaluate those past periods. And then that fourth and final point is obviously that is just your baseline starting point. And then you're going to add in those current market and then future considerations based on those reasonable and supportable forecast. So I think we'll lead into poll question 4, and then we can take a look if there's any outstanding questions we didn't get to yet. So poll question 4, the adoption of the new credit loss standard for my organization will be easy, moderately difficult, or not material, not applicable. So give everybody a time to answer. Just a quick reminder that you'll need to answer the polls in order to get your CPE credit. All right, we did have another couple questions come in. One looking at capital campaign receivables. I don't know, Roselle, if you wanted to answer that or you want me to, but I'm thinking that really is falling under that pledge accounting again.
Yep, those would fall under your contribution revenue, so non-exchange, so those would be scoped out of CECL. And
Right.
I just wanted to, again, add, I know when I look at a lot of my clients, I think, oh, this isn't going to necessarily be material for them. But still, even if it's not material, you have to go through the act of coming up with the estimate in order to determine that it is not material. So, it may be that you end up with a very similar allowance amount under one model and the other. But again, you need to go through the exercise in order to make that determination.
And then one other question that came through was asking about guarantees. So financial guarantees are in scope of the CECL standard. So if you do have any of those applicable to your organization, that would be something considered in scope under the standard. All right. I think we can move to the final slide.
There we go.
Perfect. We'll pass it over to you, Matthew.
Great. Thank you so much, Roselle and Amelia. Really appreciate you walking us through this. In front of you is a URL to register for additional sessions. Our next session is going to be on May 15th, and that's going to be covering trends that we're seeing in the staffing and resource side for not-for-profit organizations and different ways to get creative with a smaller team. Excuse me. And I did want to mention that there's a lot of great questions that have come through here. If you need help, it's okay to ask for help. So we are here as a resource for you. Feel free to follow up directly with myself, Amelia, or Roselle if you have any further questions. And if you're looking for, a holistic one-stop solution, if you don't want to deal with the memo writing and dealing with your auditors, you can definitely feel free to reach out to us. It's something we can help draft that implementation memo with you, go through the process of doing the calculations in accordance with the standard, and really concluding on any adjustments that would need to be made to apply this new standard. So feel free to reach out to us if you need some assistance. So with that, we'll close it out for this session of the speaker series. Thank you for joining, and we look forward to seeing you on the next one. So long.